From the morning reading, Alcoa misses on revenues, leads broad market to the downside. Spider breaks short-term support, falls to next level. All 10 sectors moved lower on Tuesday. XLP, XLRE, and XLF were the strongest sectors, while XLV was the weakest sector. Oil futures slipped 30 cents to close at 50.86. Breadth weakened compared to the prior session as decliners led 26.49 to 401 on the New York Stock Exchange and led 23.73 to 461 on the Nasdaq. Treasury yields are in a new uptrend. For the first time in more than 9 months, 10-year note yields have closed above their 200-day moving average, a simple but effective signal for a market's long-term trend. When yields have crossed above their long-term average for the first time in months, they have tended to keep going over the next several months at least. The Nasdaq almost closed at a high before earnings season. A tendency we've discussed in prior years is that when an index closes at an extreme prior to earnings seasons, it is more likely than not to reverse that extreme during earnings. Since 2000, that has happened to the Nasdaq every time when it was at a high prior to earnings. Stocks suffered their worst loss in a month in October. That last part tends to scare folks who are conditioned to fear this volatile time of year. When the S&P 500 has lost 1% or more for the first time in a month during October, and it had been in an uptrend, then its returns over the next month tended to be weak, but not disastrous. Follow up on 2 recent notes on extreme fund flows. In the September 15th report, we looked at a huge outflow from the Mexico fund, EWW. It has rallied hard since then, and the fund flows have started to reverse, but are nowhere near the opposite extreme, only partially reversing the mid-September outflow so far. In the September 27th report, we looked at the record outflow from currency-hedged ETFs, which tend to precede gains in the U.S. dollar. Now that the dollar has rallied, fund flows have stabilized, but they're still not yet seeing net inflows. 10-year Treasury yield hits a 4-month high. Rising 2-year yields suggest rate hike this year. Higher rates push dollar to 7-month high. The combination of higher rates and stronger dollar are pushing global stocks lower. S&P 500 nears test of the September low. The 10-year Treasury yield clears the 200-day line. Bond yields around the world continue to climb, led by the U.S. Treasuries. The chart shows the 10-year Treasury yield climbing 4 basis points to 1.76%, which is the highest level in 4 months. The TNX has also moved above its 200-day average for the first time this year. While all sovereign government funds have lost ground over the last 3 months, treasuries have lost the most. That's mainly due to the increased expectations for a rate hike this December. Those expectations have now jumped to 68%. The various markets are already pricing that in. That explains why rate-sensitive stocks have been hit so hard over the last quarter, while financials have held up better. The chart shows the 2-year Treasury yield climbing today 0.87%, which places it at a 4-month high and above the falling trend line extending back to the start of the year. The 2-year yield is the most sensitive to a potential Fed hike. Its rise is also giving a big boost to the U.S. dollar. The combination of higher rates and the stronger dollar are weighing on domestic and foreign stocks, especially emerging markets. Small caps and large caps are rolling over. Although a rising dollar has a more negative impact on larger stocks, even small caps are falling today. The chart shows the Russell 2000 Small Cap Index falling back below its 50-day average. A test of its September low appears likely. Large caps look even weaker. The chart shows the S&P 500 Large Cap Index bearing down on its September low and its June high. A close below that support line would signal a deeper correction. We've all been wondering what a Fed rate hike would do to the various financial markets. It's looking like we're starting to find out, and it's not necessarily good. A jump in crude oil to a new high for the year may also be contributing to higher interest rates. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:14 a.m. Mountain Time, and I'm recording this in preparation for the market day of October the 12th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, let's go ahead and dive into the morning report. I had quite a bit of morning reading today, but obviously yesterday's price action was pretty significant. And the overnight, at the time of this cut, were kind of mixed. And frankly, all four of the U.S. broad-based indices are just rotating around scratch. Crude oil is up about 0.25%. Euros down about 0.25%. Bonds are down about 0.33%. And gold is down just below scratch. In overseas action, you have China down about 0.25%. Hong Kong down about a little over 0.5%, Japan down over 1%, Germany and United Kingdom down just below scratch. In terms of macroeconomic reports for today, you have several FOMC members speaking, Dudley and George at different times. Also the 10-year bond auction, JOLTS job openings, and also, very importantly, later in the day, the FOMC meeting minutes. And obviously, given the action that the market has had of late in anticipation of rate hikes, those meeting minutes will be parsed very, very carefully. And looking forward to tomorrow, we have the weekly unemployment claims, import prices, nat gas storage, crude oil inventories. That's shifted by a day this week due to the Columbus Day holidays. Also, a 30-year bond auction will occur tomorrow. And in terms of current volatility conditions, obviously we had an uptick yesterday, but this is one of those things where we certainly say this was significant, and it certainly broke some important areas. We'll look at the charts here in just a moment, but yet at the same time, it didn't just absolutely go totally crazy in terms of fear premium and so forth. The short-term VIX moved up to a 13.34. That's a long way from an 18 or a 20 or even 20 plus. But certainly it was a big move yesterday. Skew is still benign at less than a 125. IV percentiles are still exceptionally low. They're still even in the lower third and still in the red here. Though they certainly popped up yesterday. The S&P at a 29, the Russell at a 13, the Nasdaq at a 25, and the Dow at a 30. You had two standard deviation moves put in on three of the index yesterday, the S&P, the Russell, and the Nasdaq, and then the Dow had a -1 standard deviation move put in. So after a period of relatively quiet action, you had a great big move come in. We certainly have been watching this chart for this coiling pattern very carefully. And, you know, the day before we had, you know, kind of this breakout to the upside. Well, that was totally wiped out yesterday with this 2 standard deviation move to the downside. And more importantly, it broke the diagonal support that had been up underneath this. And you could say that it basically broke the short-term horizontal support, though look at where it closed. It came back during the end of the session to close right back at the bottom of where that horizontal support. Now, if you were thinking that that was going to hold and that we might reverse from there, so far today, and it's small, the movement is still small, but we do seem to be kind of confirming to the downside. What is important, and you heard one of the morning authors mention it, is if we break this prior area of resistance, now turn support, that would signal a much larger correction. Right now, we're still in a sideways pattern. We're still in the cloud. We're still relatively neutral overall, but we've also had the first significant move in some 3 weeks. It really, ever since we got back here to the action here, where we had several days in a row of plus and then minus standard deviation moves, that then quieted down into a very tight pattern that went for 2 weeks. And then yesterday's action, really made a break out of that. So this is the first significant move in some real 3 weeks, and yet at the same time, we have yet to determine just how significant this is to become. Also, in other action, the Dow, it's, frankly, while the intraday, popped down to the lower part of this, recent 3-week range, it certainly came back up, much like the S&P, though it continues to start to fall today so far. In the cloud still really overall in a consolidation pattern, but the first major kind of tell as to where it might go coming out of that consolidation pattern. And the Nasdaq, which of course was also a kind of interesting point from the morning reading. One of the authors mentioned that the history of the Nasdaq putting in a new high just before earnings season is not actually a very good signal, and that did not build during the earnings signal terribly predictably. More often than not, it fell back from there. So while this has been the most bullish index, and you have this new high just literally 2 sessions ago, that leading into earnings doesn't seem to be terribly good news. And then the Russell also has now fallen into the cloud. So where it had been holding as being a more bullish pattern than the S&P or the Dow, has now degraded into a bit more of a neutral pattern, falling into the cloud. So there's not a lot of bullishness to be able to pull out of these indexes from yesterday's action, other than the fact that they pulled up off of yesterday's lows before the close. So it wasn't as bearish as it could have been, is perhaps the primary message from there. You had the very interesting action in crude oil, popping up, going up to the prior swing highs, and then bouncing back off of that, basically just in a bull flag pattern as it were right now. So that overall move, though, may have contributed in part to this weakness in the broad market, because as oil, as energy gets more expensive, that can weigh down on the broad market's profit and productivity. So something to consider with this oil move. Of course, the dollar is a big part of this, and you see, we talked several sessions ago about how the dollar had started a breakout, and most notably with respect to what gold had been doing. And look at what the dollar has done since that mention. The last week, the dollar has made a significant move, and such a move as this in the dollar has huge implications around the world. If you look at emerging markets, which had been in a bullish trend, certainly big breakdown there, and while still bullish, certainly had a pretty significant bearish move with yesterday's action. And then let's take a look at gold. And you see gold is still in this breakdown pattern. And then bonds. Of course, bonds have been hitting really hard with the anticipation that these interest rates are going to go up in this year. And, frankly, the market's pricing all that in even before it actually happens. So this continues to deteriorate, and we continue to now think of this as a more of a short and intermediate term pattern as being bearish after a very long time of being bullish. One of the interesting things about yesterday is because of the nature of the expectation of these interest rates going up, you had the markets going down, the equities going down, while at the same time you had these long bonds going down, and for that matter, gold was also certainly not doing anything. So your traditional safe haven assets, such as gold, such as long bonds, they weren't helping you at all yesterday. The other piece to this, of course, is like the utilities also not helping you to speak of yesterday, or consumer staples also not helping you yesterday. So it was one of those days where basically everything, it seemed like, was selling off and there was no safe haven. And the daily report, let's go ahead and go over there. Several very important changes here today. First of all, in our intermediate term phase opinion, we've been talking that if we had a break of that diagonal support, we would see a change. And indeed, market phase 5, the break of diagonal support, they call this the beginning of the end short term. And that we, you know, from a short-term basis, you've broken down, and now the question becomes, you know, how far this might go. Also, very important, our 3 market timing signals saw some important changes as well. The first one, which comes to us from IBD, and these are all 3 essentially mechanical in nature, is turned to an uptrend under pressure. So that is the first warning signal as the market timing signal deteriorates. So very, very important change there. Also note the GMI index is just barely holding on to its buy signal. It dropped to a 2 out of 6 on the GMI index. That buy signal has been in place since September 22nd, but is imperiled. And the third one, the stock charts decision point scoreboard, you notice we've had a lot of bouncing back and forth, and we were talking just yesterday how things are starting to look like perhaps a stack going to the positive side. Well, how quickly that was nullified, and now you have, with yesterday's action, you know, neutral to bearish on the S&P and a new neutral signal on the Dow. So again, these aren't all necessarily, you know, a lot of red arrows, but a pretty significant breakdown on the chart, and we'll have to see just where the follow-through is on that. But this is that warning sign. And, you know, as I've talked with many of you in recent weeks in various formats, one of the things I've stressed is to pay attention to when the hedge warning status goes from a 0+ to a 1. And indeed, as you're going to see here in a moment, we have elevated the risk level to a 1. It is the beginning of when you start to take actions and when you start to drill down into your portfolio and you start to analyze, you know, where are you with your exposure, where are you with your current profit targets, where are you with a whole host of different action steps. And, you know, you don't wait until you get to hedge risk level 2 or even 3. You start taking your actions now, you know, at 0+, and we'll go ahead and bounce down here. You know, at 0+, you're normal with some cautionary aspects. Well, at level 1, we've left that, and we're not normal anymore. We're now level 1, which is a caution light. And in the caution light, your sensitivity to your surroundings increase geometrically. And I liken this sometimes to the earthquake. Well, you know, a Richter scale, you know, say level 2 is very, very different than a 3, and that's very, very different from a 4. You know, you basically go up by a power of 10 when you go from a 3 to a 4. Well, when we go from a 0+ to a 1, that's meant to be an incremental increase, but it is a significant increase in the hedge warning status, and that you should be taking a very close look at everything in your portfolio and starting to prepare your portfolio for the potential that something larger might be starting to develop. And don't wait until that actually occurs to be taking actions. It might be too late at that point. Position sizing opinions, the first model has dropped to 50%, though the volatility model is still at 75%. In terms of the intermediate term market posture, this signal has been flipping back and forth, and well, it's back to first day weak bear signal again. Also note that we have a weak bear sentiment line. So that actually changed a few sessions ago. I didn't catch it at the time, but we no longer are supported by a bullish sentiment line. This is a longer term signal, But this starts to mean that the bearish moves could be a little bit larger than the bullish moves. And so that could be another one of those additive kind of signs or indicators that things might be changing in our market posture. But the intermediate term market posture, S&P just barely holding on the weak bear. If it drops below 50, it actually goes to strong bear. The Dow's already at a strong bear. The Russell's also at a weak bear, a little bit higher up over the 50 threshold, but certainly, is much closer to 50 than it is to 80. Now, the Nasdaq is still holding on to this severely strong bull, but that won't last much longer if it drops below an 80 and this action starts to build at all. Now, I'm couching all this as if we might start to further deteriorate, and certainly that's what we're on guard for, but we also have to be on guard for the fact that the bulls, if the market is truly in a bigger picture bullish, then just when things seem to be starting to break down is when the bulls will come in and reverse this. So watch those bounces, watch how strong, how broad that participation is, how much energy, how much volume that might have. And if you see to where none of those things seem to be having much in the way of energy, it may be more of a bear flag setting up than a bull flag. So we talked about the hedge warning status. Along with those changes, we see some changes in the strategy opinions. The VIX is still acceptable to initiate new positions. It's still, while it rose yesterday, certainly did not go crazy by any means. It's, right now, a live market, it's about a 16. So, that certainly is not in that 12 to 15 area, and yet it's still within the acceptable window of 12 to 18 that we normally use as our option income strategies threshold for novice traders. So, the more aggressive traders, in fact, might even relish this in that they can get some additional premium. Just understand that as the market starts to potentially deteriorate, you might be dealing with a situation where adjustments and all become more necessary. So covered call strategies and put selling, the conditions are dropped to not acceptable to initiate new positions for novice traders. More aggressive traders would certainly want to, at the very least, take advantage of very defensive kind of structures, and we continue to use this 2-to-1 ratio of in the money, out of the money strikes. Also, the 2-to-1 ratio of low beta and high beta positions in the portfolio composition. This can be an opportunity to potentially increase your put selling if you're an aggressive trader. Obviously use your tools, watch your individual charts and so forth, looking for what makes sense in terms of bottoming patterns to be able to put those on, get those prices that you want, get those strike levels that you want that are around, strong support areas. But most importantly, as these situations potentially deteriorate, make sure that you're using defined risk positions, spread those put selling into spread positions, but also position size and a scale that you're actually willing to own. And that may come very important in the days to come should this situation start to deteriorate. Another piece to this is we always talk about the individual warning area, the change, but also the rate of change. And certainly we saw both change and significant rate of change acceleration with yesterday's action. In the volatility area, market in decline, sharp increase warning fired yesterday. The volatility ratio warning fired 2 sessions ago. At the first, we thought, that's kind of interesting. And it was also sitting there with just this high distribution day count with the S&P. Well, now it's been joined by several other warnings, including the distribution day count, not just increasing on the S&P, but also Nasdaq now going into warning status. In terms of the trend base, we've got a couple warnings here that market phase 5 is a warning, the weak bear on the intermediate term market posture is a warning, and then you also have the New York Stock Exchange new highs, new lows on the 1-month time frame going into warning status as well. On the intermarket risk aversion indicators, you have still risk on postures, but you have the 4th one here in a rolling over status, and the 5th one could be also called rolling over. It was very close to being able to describe it that way. In terms of sentiment relatively low, and indeed you see a little bit of fear starting to come into the market. Certainly not far off the neutral, but it is the first time we've seen fear in the sentiment index in some time. Though if you go back a month ago, we certainly were back in this range at that point as well. From a sector specific, this is quite significant. You got one big green area. Well, that's one company. Remember, telecom is made up of only 5 companies. You had one positive there. But other than that, there's very little green to be represented in yesterday's action. So not only was there broad sell-off in all sectors, both high beta and low beta, both risk on and risk off, more defensive oriented, but also the breadth of that sell-off was quite significant. And when you look at the intermediate term, short-term, and long-term market postures by sector, you see quite a bit more red now showing up, with only transportation, energy, and financials holding up as still bullish. And the red yesterday, of course, carried through to make many of the 5 days and even now into the 1 month and 3 month red as well. So when you've been sideways for so long and then you get any kind of negative at all, it basically turns the returns from all those upper time frames negative as well, because we just haven't achieved anything of note in terms of significant new highs. We just kind of dribble into new highs and then quickly seemingly give those back up in this ranging action that we've lived with almost 2 years now. We talked about the big time ranging action. Well, it goes really back all the way to November of 2014 to where this sideways action in the market really started, and an awful lot of this action of late has been just achieving nothing to the upside or the downside, and the first time you go towards the downside of the range, everything looks red. So something to consider here as we put all this together. This is a very, very different report than that we had yesterday. We've been talking about the potential for quick change and deterioration, given that the cooling was so set up to potentially go this direction, and you have to kind of recognize this is the first kind of warning shot. So that's quite a bit of news for today. I've gone very long, so let's go ahead and wrap this thing up. But bottom line to this is that you're going to want to pay attention to what's going on in the market and for the next few days to see how this might resolve on confirm itself or be rejected. But this is kind of your first shot across the bow. Disclaimers as always. Hit the pause button if you need more time to review the disclaimers. Then also note the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here for the next market preview from Falcon Global. In the meantime, manage that risk. It is ultimately about the management of your risk profile, and then everything else should fall into place. We'll see you tomorrow. In the meantime, go learn something.